Hello, it's Friday, March 24th, 2017. I'm Steve Houston, and I'm here visiting with Joe Terril and Company, to catch up a bit on the markets and investing. And Joe, the Fed raised interest rates last week. The business media's weighed in, but what are your thoughts?
The markets have reacted in an unexpected manner to the interest rate increase. Longer-term interest rates have come down, and markets have muddled along, to say the least. We are still in the camp at Terril and Company that interest rates are going higher, inflation is going higher. The markets disagree with that, and that's why longer-term rates came down. They think the Fed will raise a couple more times, it'll be all over with and finished. We're not anticipating that. We think inflation is going to force the Fed to raise interest rates this year, 2017, but also next year, 2018. So ultimately, we see short-term interest rates somewhere in the 2% range and 10-year U.S. Treasuries somewhere in the 3.5% range. This is higher than what the markets think. And it's really, to answer your question directly, higher than what the media is sort of reporting on what economists believe.
So how does this play out in the U.S. economy, and how will the investment markets react?
In the U.S. economy, the higher interest rates will not affect the economy in the United States in a negative fashion. After all, we're not talking here about interest rates, if you turn the clock back 20 years ago, going from 8% up to 10.5%. We're talking about an increase from 0 to 2%. It's not going to have a negative effect on the U.S. economy. What we see happening right now is a stronger U.S. economy. Unemployment is low. Average hours worked is going up. Average hourly earnings, although moving slowly, are going higher. And consequently, the consumer is in good shape. The consumer is going to be willing to spend. Say it in another manner, that if I get a home mortgage at 3%, if the economy is doing well, I'm confident that I have a job and I'm making more money, I'm not going to back away from buying a new home because I have to pay 4.5% on a mortgage.
So Joe, you told me that the world economy is doing fine right now. So what are the implications of that?
It's going to be positive for the United States economy, and it'll be positive around the world. I'm not sure why there's this fear out there of Europe's going to go into a tailspin. Not true. Europe is doing better. The economy's actually back to growing again. Of course, we had to fear that Brexit was going to drag Great Britain down the tubes. Not true. Great Britain's economy is growing at 2% plus. Their unemployment is 4.7, which equals ours. They're doing well. China, Korea, the South Pacific, their economies are rolling right along, doing well. There's good intrinsic demand all over the world right now for materials, services, not at all concerned about the world economy. That will help the United States economy that's beginning to pick up and do better than the 1.75% growth we've seen. Our economy in the United States should begin to accelerate and go more towards a 3% growth. Certainly, this should be a positive for investment markets, but we have other considerations here to take into account.
So given all we've talked about, how are you positioning your clients' portfolios?
Well, right now, Steve, I think you have to stay away from fixed income that has any type of duration, you will see principal prices go down on most all bonds as interest rates go up. The exception of that, of course, would be floating rate bonds, or, as our portfolios hold right now, very short maturities that will come due sometime in the next 18 months. So that's your fixed income side. On the equity side, you have to wait to see how is the Federal Reserve Bank of the United States, the Central Bank of Europe, going to respond to the higher inflation that we're beginning to see. If inflation, which I believe it will, picks up and starts to run north of 2%, is the Fed going to do the proper thing and raise interest rates, like I think they will, per our earlier question, or will the Fed drag their feet and fall behind the curve? If the Fed drags their feet and falls behind the curve, equity markets are going to go lower. If the Fed raises rates appropriately and stays with it, then equity markets will hold in there and do okay. Ultimately, we have to judge equity markets upon, are we going to get to a level where interest rates become competitive again versus equities? Stocks have had, or equities if you will, have had their way for the past 5 years because there were no alternatives. Interest rates were zero. If we get back to 3.5%, or we get corporate bond rates where you can earn 4% plus, will that create some competition for stocks? I tend to think it will. Therefore, I'm a little cautious about what type of stocks I buy and what type of positioning we have there. I do think the things that will take advantage of higher interest rates and higher commodity prices will do real well. By that, I mean the financial stocks will do better as interest rates go up, and some of the energy partnerships that are providing 7, 8, 9% distribution levels are going to do well as energy prices hold in, and the demand around the world, because of a strong world economy, keeps oil prices somewhere in the $50, $55 range. Those two things will be very advantageous. So in equities, centered towards financials, centered towards energy, and then other things that we think maybe are more specific stock picks, very low maturities on bonds, low meaning short. And we'll see. We have to wait and see over the next 6 months, is the Fed going to step up and do the right thing? They really didn't last year. As you remember, they said we're going to have 4 increases, and then they got afraid and only increased once. We'll see what they do this year.
Well, thanks, Joe. Always enlightening. That's Joe Terril, Terril and Company, independent investment advisors with $725 million in discretionary assets under management. And Joe, let's do this again sometime. And thank you for joining us.
Thanks, Steve.